for joining me on another one of my videos. And how would you, my question for you is, how would you like to have a mortgage with an interest rate in the low fives? In other words, 5%. So that's a great deal. It sounds like that's hard to get in today's environment. Well, I'm going to tell you how, and it's called a 2-1 buydown. The important thing you need to know on a 2-1 buydown is number one, all types of loans qualify. So in other words, if you have a conventional loan, an insured conventional, an FHA, or even a VA, all those loan types can have a 2-1 buydown attached to it. So that's number one. Number two, what's important is the cost of the 2-1 buydown, and I'll explain that to you in just a moment, is paid by the seller. In fact, it's required to be paid by the seller. And oftentimes, if you have a home that's been on the market for a little while, the seller's willing to do that instead of doing a price adjustment on their list price. So that's number two. And number three, it is important, not all lenders do 2-1 buydowns. So with that said, I want to explain to you just a little bit how a 2-1 buydown works. And first of all, there is a 3-2-1 buydown, and that would be for 3 years. There's a 2-1 buydown, and that's for 2 years. And then there's a 1-0 buydown, and that's for 1 year. So I'm just going to talk about the 2-1, but they all basically work the same way. So I'm going to use some numbers that are fairly easy from a standpoint of rounding, but let's just say you're a buyer and you have a home that costs $300,000, and we're going to say that you have a conventional loan and you're putting 20% down. So your mortgage would be $240,000, and we're going to say it's a 7% interest rate because that's about where things are today based on your credit score or the type of loan. But we're going to say it's a 30-year mortgage at 7%. So with that said, a payment, not including interest and taxes, but your payment on 7% for 30 years for $240,000 is $1,600. So the 2 on the 2-1 buydown is reducing that interest rate from 7% to 5%. That gets your mortgage all the way down to $1,300. So for the first year, you are saving $300 a month. So 300 times 12 is $3,600. The second year, your interest rate is 6%. And the savings on that from a 7% payment is $150. So that total over 12 months is $1,800. So you add those two numbers together, and that's $5,400. And the seller is paying all of that, and that's how it's shown on the closing statement. So you have to be able to already qualify at the 7% at the higher rate. At the end of those 2 years, you could possibly go back to 7%, or most likely, and this is what a lot of people are using the 2-1 buydowns now for, is the interest rates are going to reduce before that. They'll probably or most likely be less than that they are today. So people are going to refinance into a permanent interest rate for the 30 years, and they will have got that early interest savings from the seller when they bought their new house. So if you'd like to know more about that plan, we have a lender who offers that. All of our agents are aware of that type of program. They'd be happy to explain that to you. Feel free to visit us at markdietel.com. You can call me anytime at my mobile number at 317-441-7887. Again, that's 317-441-7887, and I'd be happy to help you.